Good day, all. Ira Epstein of Linn Associates with your agriculture update, and we're now on Tuesday, and this is the 7th of May, 2019 at 2 p.m. Central Daylight Time. A bit of a bounce in the grains, but it's more of a relief bounce right now than it feels like anything else. And I only say that because we're down so much in the stock market. Now, obviously, what's happened is trade is the big issue, and this break in the stock market. I was just watching on CNBC. They talk about whether it'll have legs to it off of trade. Where the bigger leg comes in, like it did in December in financial markets, is if a Fed missteps. And I think Steve Grasso was talking about it, and I think he's right. Trade seems to resolve itself a little differently because if you get enough trade that goes down, interest rates fall at that point, and you can see you're getting that right now in the marketplace, and one counters the other to a degree. What agriculture's got negative about it is nobody's protecting the farmer. No matter what the Trump administration says, if you watch and you see how the farmers are doing, and I've been brought up in this part of the industry as well, very painful. You're going to see some small, medium farms have to get out of the business. I talked about these retirement auctions they're having. They're still going on. When we take a look at a weekly area chart of closes, we're only at Tuesday and the market's down 11 3/4 cents, knocking on the door of this old 814 area on a closing basis. So you're 3 cents away from that. When we take a look at how the markets come down, the one thing I pointed out yesterday is markets don't like gaps. They try to fill them, and they try to do it generally on a fairly soon basis. So in between here, if we come back, you can see that the low of this day was 840.5. We gapped away from it, and today's high was 836.25. So you've got about 4 cents to go in order to fill the gap, and then I'd look to see if any resistance shows up on that chart. In terms of the swing line study, and this is a chart without the swing line showing that you've got a pattern of lower highs, lower lows. Remember, swing lines, and I wrote this study, what it does is it looks to see is the current trading day an inside day, a day of a higher high, a lower low, an outside day up or down. And then I have 5 rules that I teach in my charting course, and that's how I created the indicator. And the idea is to see, number one, if you're trending, number two, what's the risk associated with the trend? Well, you'd have to get back over 896 3/4 in order to break the pattern of lower highs and lower lows. So considering how far that is away, the odds favor the market would develop a new pattern, even if this market decided to rally, if it's going to break the downtrend. I filter the swing line with moving averages, and the rule on this is if the market's under the 18-day average, I have downside bias. Another thing I look at, wherever that number comes in, it is not uncommon that if you get a strong rally back in the market, that wherever this ends up coming in, that'll be a resistance point. Sort of what happened here, as the market came back up. It's where the market gets a shot at regrouping, and a lot of people look at moving averages, so you should learn how to work with them. The next thing that I look at is Bollinger Bands. Now that's this black dashed line here and here. The first thing to realize is, number one, unlike window envelopes or some other studies, they're not meant to run parallel to each other. Do they at times? Pretty close to it. You get this sideways action, but it's from there that I always will tell you, when you're sideways, think of it as a pipe and a spring in it. You keep winding it, and eventually it's going to burst out of that one way or the other. And what happened in soybeans is it came down. Is price a reality? Yeah, market's looking for values. That's why you fall or go up. You're looking for a point of value. In slow stochastics, this is the momentum study. And until the red line closes under 20, I view the rallies in the market as no more than, what should we say, a bounce in a bear market. And off that bounce, I look for the pros to sell into the market. So I still see that as the case here. When we come to the soybean meal market, you can see this market stayed down today. It's got the embedded reading still. Embedded occurs not like this. I'll just take you over here. This is oversold. That's overbought. But when the numbers start locking in under 20, and I'll get to it right through here, you can see it there, it often leads to price wanting to what? work itself lower, and the market's telling you that on rallies it's probably going to encounter selling. And that's just what's been happening in the market. Now, the support is the Bollinger Band, only because what the Bollinger Band offers is an algorithm designed to keep the market within it 95% of the time. So what will happen? Yeah, you can settle outside of the band, but you're not going to stay outside of it on the upside or the downside very long. You see that more in the soy oil. Yes, you could step out of it a little bit, but it'll move back into that band over time. Now, in this market, I'm looking at what the slow stochastic did, and both numbers are still under the 20 level. They were under 20 yesterday, and they were under it the day before and the day before. So you're still getting the market in terms of the momentum is still down, but the market is also paying attention to not staying under the Bollinger Band, and that's one of the reasons that you're bouncing. When you lose the embedded reading, then I look for price and the 18-day average to try to come together. In the corn market, we have a pattern of a lower low, higher high. Now, if you'll notice, this market went right to the Bollinger Band, stopped its decline. Here, you gave away a little price action, but not enough for me to say, And what do I mean by You're not in a sideways market yet. So a bounce doesn't mean anything other than the pros taking their money off the table in areas. In the wheat market, you lost the embedded reading right here. That often leads to price and the 18-day average making a run at each other. Now, what I didn't and still don't know was this enough the day it happened to get within a penny of itself? You know, you could say they made a run at each other and they failed here. Often they'll get closer than that penny, and I'm wondering if that's not what the market's working on right now. A close over 445.25 would be a sign this market has exhausted itself in the near term on the downside. In the sugar market, we are still from the sideways action, and this is what I mean by more sideways action. Think of it as a pipe, these black lines, and you're just spinning around. And when you break out of it, one way or the other, and when will it break out? I wish I could tell you that. I'd be the richest man in the world. What I can tell you is first supports, resistance, and then when you start coming out, I often look to see what is the stochastic doing. If it's just oversold, I can't answer the question. But if it starts embedding, it's often a sign that you're going to have a bigger run than you might think, and that's what sugar's been doing so far. Lose the embedded reading, and then I'd say from this pattern, the market has now exhausted itself. I'm not seeing that yet. In the coffee market, this is the market that everybody, and I read these articles from all over the world, not just the United States. The coffee can't keep going down, it's under the cost of production. Okay, so produce less and then there'll be less supply. But right now you're making new lows in this contract, so it is still dropping on you. Cocoa today entered a down phase. The market's got lower highs, lower lows. Yesterday it closed under the 18-day average, but it had a pattern yesterday of higher lows, lower highs. The key is to take out 2310 and see how the market reacts at that 100-day average. It hung there, if you will. The market finished at 2301 under that 2314, but now what it does is because momentum just turned down, I would think that the market will encounter first resistance 2314, second resistance 2348, and to break the bear trend, you'd have to get back over 2400. Should the market decide to work lower, the possibility exists of the lower Bollinger Band coming into play like it did back here to offer some support to the market and a zone where the shorts might decide to cover some position. Cotton market, very similar to sugar. Here's that sideways pattern again. The market tries breaking out. First it stops at the Bollinger Band, day before this, then the 100-day average in it. And then the market starts the acceleration. And again, I'm always going to look to see, you're getting an embedded reading. And until you get it, I just don't know if the market's going to be able to stay under that or bounce. But once it embeds, I have a better feel for what the market's going to do. Now I'm still seeing resistance at the 100-day average. The 18's certainly there, but this number's the closest of the averages, so that's your resistance point. You have not embedded. You're just oversold. The market has now got day one under the Bollinger Band. Yesterday it was under it. That's 2 days in a row. And if I go here, the market finished at 68. That is over the 61 level. So you have 2 days in a row under the lower Bollinger Band. My rule of thumb, and that's all it is, folks, is I take each consecutive day under it and subtract it from that 5% of the time the market stays out of it. It's not a sign that you have to cover or anything. It just gives a pretty good idea as to where you're at. The one thing I teach traders, right or wrong, it doesn't matter to me, is that selling under a Bollinger Band, you can generally do better to the right-hand side of it. In the cattle market, the market's been running the lower Bollinger Band with an embedded reading, and you finally got an inside day where the market's pausing. That's all it's done. The question is, this rules the day. So until you lose that reading, I still say the pros are looking to sell rallies. The same in the feeder cattle. Resistance all the way up here at 152. This type of vertical decline, if you're trying to sell into it, very dangerous because it can just move on you for no reason. And in the hog market, you finally got back. The word is back down today to the lower Bollinger Band, found your support against it, and rallied off that number 200 points off of it on a closing basis. So an interesting day that happened there. So where are we on all this? Well, you know, everything's changing on a moment's notice. And one of the tools I use during the day on a day like today, I like to see where these pivot points are. All that a pivot point does is it looks at the previous day's high, low, close, and then via a formula, I didn't write any of this, it's been around a long time, is you're looking to find resistance points above the market, support below the market, using this constant formula. A lot of traders that I know use this. So you'll come up with, just like you see here, this white line, which is called the pivot. Then you get resistance line 1, 2, support line 1, 2. And what I do is I tie that together with the momentum of the slow stochastic reading. So as I'm watching the market intraday, I'm trying to see, is the market ahead of itself? Gee, that's where maybe that Bollinger Bands come in, and you say to yourself, maybe this is a great spot not to be in this market anymore. If you'd like to see this, it's a 3-part video series. We email it right to you. Just go to our website, sign up for it. You can call us. You can go to our website. You'll see our carousel of free offers. Click on it. Anything else you'd want, or you can click up here. It'll take you right there. I'm Ira Epstein. You have a good day.